This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is see you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's episode dives into private credit and building an asset management business inside of a leading global bank. We sat down in Nomura's NYC office with Robert Stark, the CEO of Nomura Capital Management and head of investment management in the Americas for the Nomura Group. Robert brings deep experience in financial services to Nomura. He was previously the founder and CEO of Alterum Capital Partners, where he focused on building an investment management business at the intersection of private markets and RIAs. Prior to Alterum, he was a senior managing director and a member of the executive committee at FS Investments, where he was responsible for corporate development. He also spent 7 years at JP Morgan across asset and wealth management. He joined JP Morgan from Russell Investments, where he was a member of the executive committee. And he started his professional career at McKinsey Company, where he was a partner serving clients in asset management, investment banking, insurance, and private equity. Robert and I had a fascinating and wide-ranging discussion about the state of private credit market, how to build an asset management business, and what it takes to work with the Wealth Channel. Thanks, Robert, for coming on the show to share your wisdom and expertise on private markets and wealth management.
We're going mainstream.
Robert, welcome to the Alt Goes Mainstream podcast.
Michael, thank you for having me.
Well, pleasure to be here with you at Nomura here in New York. Such a fascinating conversation on tap. I think you've built a business here at Nomura. We'll get into that and how you've basically taken an entrepreneurial environment, startup within much larger global bank. And then there's a lot to talk about on private credit. So first, would love to start with your background. You've seen the asset management space evolve. You've been in the asset management space in a number of ways. So we'd love to hear how you ended up here.
Great. Well, thank you for having me, first and foremost. So I'm dating myself, but I've been in the industry for about a quarter of a century and always been involved in asset management. And I think it's fair to say that this industry has changed a lot, and the speed of change, especially over the last 5 years, has been absolutely astonishing. Number one, when you think about the regulatory environment, how that has pushed away banks from a lot of lending activities, just to give you one example. Number two, if you think about the continuous shift from the public side into the private side. And number three, and that's true across the entire industry, continuous push towards lower fee products. And that's actually true on the active side, the passive side, the public side, the private side. It's true everywhere. At the end of the day, it's a better client experience to have lower cost oriented solutions. And then the last thing I will say, number four, is the market structure has changed dramatically as well. And by market structure, I mean two things. A, the actual firms, the asset managers. I think I wrote in one of my previous lives, I wrote a piece around the future of the asset management industry. And 15 years ago, we predicted there will be a handful of trillion-dollar firms. Today, if you're not a trillion-dollar, you're not a top 20 asset manager. And then B, market structure as in the involvement and engagement that asset managers have in the actual markets. And that has changed dramatically, again, with banks retrenching from quite a lot of activities.
So if we put on some of your prior hats, you were a consultant, you were in the corporate strategy function, you're now running a business here at Nomura. What do you think from your two prior lives, if you were to diagnose where we are in asset management today and why you decided to take on the role that you took on? I'd love to hear that perspective of things.
So I was a consultant for 10 years. And as consultants, obviously, you have a mandate to tell the truth or what you believe the truth is. And when you don't see your clients adopting that, so I remember having had conversation with various asset management CEOs in like the years, call it 2005 through 2010, about ETFs and whether they should build an ETF business. At the time, most firms and individuals told me that you can't have an ETF brand and a traditional non-ETF brand together. I think it's fair to say that that's no longer true. So then I thought maybe I should do it inside a real firm. So I joined different asset management organizations. So I was able not only to formulate a strategy, but also to execute upon it. But what I then realized is many firms act a little slower than I would have hoped. And a lot of firms that I worked with went into the right direction, but it took quite some time organizationally to get there. And that has a lot to do with how they make decisions, having the right people or not having the right people in place. And just like if you're working for super tankers, it takes a while to change direction a little bit. So that's ultimately prepared me or got me to a point where I thought, maybe I need to do this myself. So I've gained enough experience. I felt over the years, both painfully as well as gratifully, that eventually allowed me to take the step and do it myself on a more standalone basis. But then I realized you can't do it completely standalone because you need capital. And if you want to build a business in private market, you need a lot of capital. And that is true both for seeding products as well as having the appropriate working capital to hire a team. Because this is not your typical AI tech startup where you hire a bunch of coders and do it all from the home office. That doesn't work in asset management, I'm afraid. And so I needed a partner where the partnership is such that I can build something from scratch. And there is an entrepreneurial culture as well as long-term commitment to do that. And I found that here at Nomura.
So what's interesting about what you just said is a lot of that is the soft side of finding the right partner, building the right type of business and asset management. We'll get to that because I think that's all really important. But when you think about having worked with many asset managers and doing it in the strategy function that you were in, operating, what do you think are the unique differentiators about an asset manager today? So when you were thinking about building Nomura Capital Management, what do you say, okay, these are the things we need to have that others maybe don't have, or what does Nomura have that others don't have that we can bring to bear?
Yeah, it all starts with finding the right people. That's the bottom line. If you have the right people, if you can attract and retain the right people, that's basically 80% of the equation. The rest is, do you actually can you build a differentiated strategy in an environment that's changing very, very rapidly? And so when I started thinking about private credit, for example, that journey started probably 6 years ago. And it evolved from an idea to maybe there's something, to many, many conversations that eventually got me to a point where I was convinced that there's a gap, there's a unique opportunity, and I needed to find the right people that help me get there. And by the right people, it's not only the people you're building it with, but also the people that you can trust, that lend you the money and give you the entrepreneurial freedom to do what you have to do if you build essentially a private credit business from scratch.
What did you think was missing in private credit when you set out to build Nomura's private credit business?
I think it's fair to say that private credit really grew alongside private equity, but a little bit later. And the global financial crisis was probably one of the key events that really helped, especially direct lending, grow at rapid speed. And so most of private credit today is still direct lending. And so what I realized was it's great that there's so many opportunities in direct lending, but private credit is a lot more than just direct lending. So when you then start looking for investment solutions in this space, you realize that there aren't that many. So eventually I thought there must be a way to provide private credit exposure to sort of a broader retail audience by giving them a very diverse way of accessing private credit. And diverse meaning not only direct lending, but all the other asset classes that make up private credit in total, whether it's asset-based lending, real estate lending, especially finance. That includes things like royalties, for example, litigation finance, aircraft leasing, all these areas. And if you add it all up, direct lending is maybe 1.5 to 2 trillion in assets, but all the other things I just mentioned is maybe another $12 trillion. Again, most of it is still on the bank's balance sheet, but that is going to change over the next decade, I would say.
When did you see that that was a secular trend that was changing, coming off a bank balance sheet and going into the hands of private credit instead?
My view was that it's more like, I didn't really see it in actual numbers. It was more like inevitable. It was kind of a no-brainer. So if you can do it on and really go against the banks, and they were all about the syndication and the junk bond market at the end of the day, if that had already happened, it was more a question of time when it would also happen with some of the other asset classes within private credit. But quite frankly, it all started by thinking about what's the right solution for the end client. So it's really starting from what is it that we think the end client is missing. Granted that the typical end client that I'm thinking about isn't your 10, 20, $100 million client. The typical end client I'm thinking about is somewhere between probably $1 to $10 million. I'm not thinking about like the $100,000 household, because I'm not really sure they should invest in private markets, quite frankly. So if you think about, if you have that client in mind, most of which cannot by default invest in drawdown structures because they are not qualified purchasers. So you have to bring that further down. And then the question is, how many funds or solutions do you want them to invest in the first place? So that's where the idea of diversification came in. That's when we thought there is an opportunity to create a solution that is a diversification play for private credit, almost like your one-stop shop private credit solution. If you want to build something around the edges, you want more direct lending, you want more asset-based lending, you can add other products. But the idea was to have a strategy that allows the advisor and their end clients to have a significant allocation to private credit with one single solution.
I think you're hitting on something on the investor side, which is so important, which is advisors often want less solutions, not more. They want really high quality ones, right? They want less, not more. As you thought about building out the credit business here, you've chosen to both invest in deals or lend directly to borrowers, but also invest in other funds. Why go that route?
So the solution we've built is really geared towards becoming a rather sizable solution. So for that, you need a lot of origination. And we have that in-house, but we also have various origination partners, whether it's other asset managers, whether it's origination firms, whether it's banks, law firms, you name it. So it's really a very, very broad network, and it's built for scale. But scale doesn't come from one day to another. It takes time until you get there. So what we have experienced is in the early days, it's really having a handful of very closely aligned partners. And Nomura in that angle is actually quite important because I want to come back to the entrepreneurial side of things. So we came here with the idea of building a private credit business from scratch, but we also came with a 10-year business plan. So Nomura underwrote that business plan, acknowledging the fact that it's going to take 10 years to build this. What finally convinced me was that everything we do here in the US is credit-oriented investing. We've historically done this predominantly on the public markets. So we have a high-yield investment boutique that is called NCRAM, and we've been around since 1991. So that was also something that was built within Nomura from scratch, except it was 34 years ago. And Nomura had the stamina to keep these guys along and let them grow pretty handsomely to over 35 billion in assets today. So that tells you a little bit about the magnitude of entrepreneurism that you get here at the firm like Nomura. And so if you now add the private credit side of things to it, we are now all able to offer a credit solution that cut across both the public credit side as well as increasingly moving into the private credit side of things.
I think that brings up a really interesting point. One, you've chosen to harmonize those two sides of the business, the high yield business on the public side, and then you have private credit. As we live in this world of increasingly blurred lines between public and private, why do you think it's helpful to have one business across both public and private? What does that mean for both borrowers and investors?
So my view is that credit investing, you could make the same argument for the equity side as well, but it's increasingly blurring between public and private. Not that the actual investments are blurring. What is blurring is what the client ultimately wants. To me, credit investing is, you should think of credit investing as a continuum from public through structured all the way to the private side of things. So at the end of the day, whatever the end client wants in terms of income at a certain level of liquidity. You want more income? You got to accept there's going to be slightly less liquidity. You want lower income? There's going to be a lot of liquidity. So it becomes a client solution. Now, if you're an institutional client, you can tailor that. You can insource some of it, or you work with a manager or multiple managers to create and structure something that fits your needs, whether you're a pension fund and you have asset liability matching purposes, and you need to match one side with the other. Or if you are a retail investor, there's going to be more and more products, and we see this already, where the actual solution that you're buying is some combination of public and private credit.
How much does having both public and private capabilities make it better for the investor, better for you as well in terms of how you're able to kind of shift between the two and say, okay, maybe at this point in time in the market, maybe public makes more sense versus private, and then provide that solution to an investor?
Yeah, at the end of the day, I wouldn't describe it as in, if you don't like this today, you'll like that. So we have like the red pill and the blue pill. That's not how I would describe it. I think each side has to fulfill whatever is the mandate, and it's all grained in the investment excellence that you want to provide. So the key is, if you do each thing separate from each other well, now what that allows you to do over time is to combine them in different ways. And the more ingredients you have, the more you can combine them and the more bespoke solutions you can create for any given client. Now, you can do this in an open architecture model. The first solution that we have created, the diversified private credit strategy, is open architecture in nature to allow for more scalability. But over time, you can have smaller solutions and they can be closed architecture and you add more of your own in-house capabilities. So the more you have, the more you can do that. But I wouldn't say it's because if this doesn't work, the other thing is going to work.
How much do you think investors would rather have a one-stop solution for something like credit where they can then come to you for both public credit and private credit?
I don't think investors are looking for necessarily for one-stop solutions in everything. I think what investors are looking for is what is the right investment solution for a given problem that they're trying to solve for. And it's also fair to say we can talk about larger firms, whether it's distribution firms, whether it's wealth management firms, whether it's pension funds, insurance companies. Yes, they may select fewer partners, but they're not going to select one or two only. They still need, from their own fiduciary responsibility perspective, they need to provide a whole range of investment capabilities that they are sourcing from various managers. They can't be just a handful of managers, but it won't be, because no one has that much time and resources, they won't be 50 managers on each side. So yes, the number of managers is going to come down, but it's not going to come down to a level where you only have a handful.
I want to touch on the origination piece, which you talked about earlier. I think that's so important. When we talk about private credit, it's something that many firms have talked about in their own way. Some have bought origination platforms. What do you think makes for edge in origination?
So first of all, the question is, what are your origination engine? What are you originating for? And second, how do you actually go about it? So what we have decided is that we have a network of originators. Let's take an example. We love and see a lot of deal activity in bridge loans. That can be commercial real estate, residential real estate. It can be residential transitional loans, for example. We see a lot of opportunity in that space, and we put that in our various strategies that we offer to our investors. For that, we know who the key origination partners are because we have a very clear idea of what we want the loan profile to look like. Now, whether we do this for our partners, whether we do this in part to ourselves, but it really comes from where we see the opportunity, and then we really double down on that.
What do you think is the hardest part in today's world of private credit when it comes to deciding where to own something in closed architecture, or be captive about how you do things versus be more open architecture and partner? I imagine that is a challenge, but also given your background, being in strategy probably makes it really fun.
Well, I would say open architecture can be interpreted differently. What I mean by that is when you do co-investments, whether we originate a loan and we co-invest, like we give it out to other managers or vice versa, the question is, where do you put co-investments? Some would define that as, well, you're just co-investing. Others would define this as it's a whole complete re-underwriting of the same loan. So at the end of the day, it comes down to who actually originates the loan. But at the end of the day, many firms view co-investments and it's the same thing. But it comes down to origination again. I think the real challenge is, what is the strategy that you're offering your clients? So what is the purpose of the strategy? The purpose of our diversified private credit strategy is to provide you access to a whole variety of asset classes within private credit. You can't really do this purely a closed architecture. We feel you would be missing out on so many opportunities that, especially if you're solving for something that you want to become a multi-billion-dollar solution, you have to be open-minded in terms of origination.
On that point, when I hear you say that, I hear you clearly articulate the value proposition for your fund and solution to the end investors. Obviously, there's a lot of education that goes on in the process of helping people understand how to navigate private credit and then private markets more generally. Do you think oftentimes allocators, particularly in the wealth channel, are coming knowing exactly why they want a specific solution and what they want that solution to do?
I think it goes both ways, quite frankly. So let me give you two data points. One is many financial advisory firms, whether it's large RAs, whether it's the wealth firms, the wirehouses, independent broker-dealers, they have very sophisticated manager research and due diligence teams. So they really know what they're doing. And it's typically also driven by an agenda in terms of what type of solutions they are looking for. So if there is a search for an asset-based lending strategy, they really understand the space well. But you're going to have a fair shot in that sense. But second, before coming to market with our solution for the diversification benefit, we actually interviewed, I want to say 50 RAs, and it was either the founder who was also the CIO or it was the CIO. And we asked around their usage of private credit solutions. And what became very clear was that most firms only had direct lending as a solution. So when you then say, oh, do you want specialty finance only or asset-based lending only, or do you want something that actually allocates across the private credit spectrum? Every single firm said we want the latter. So we use this sort of client data point and feedback in our product development process. And so when you think about product development, we literally we had an idea, but we wanted to hear from clients directly. So we got the client feedback, we embedded that into our development process. We then thought about who is the end client, and that eventually got us to the fund structure. But it really was a whole process that took, I want to say 18 to 24 months from here's an idea all the way to here you have actually a solution that's eligible to be bought by investors.
So you spent a lot of time talking with the wealth channel to understand what they wanted and needed. What was the biggest takeaway or learning that you had from those conversations?
That we're still very, very early. Look, I grew up in Germany, as you probably have figured by now of my beautiful accent. A baseball analogy would really be we're in the very early innings. We're not in the first inning, maybe not in the second, but we are in one of the earlier innings still. And I mean that by, if you look at, take interval funds and tender offer funds, which combined maybe is, call it 3, maybe 400 billion in AUM. Compare that to mutual funds or ETFs. I'm not even including separate accounts for that matter, or SMAs. So it is tiny compared to the exposure end investors have through other vehicles.
Do you think this is going to go the same way as the mutual fund and ETF industries evolved?
I would certainly hope so. That would mean we still have a very long way to go, but I wouldn't be surprised, and it probably doesn't need a genius to tell you that structures such as interval funds, tender offer funds, even if you include non-traded REITs, BDCs, or operating companies, wouldn't be surprised if that hits $1 trillion in the next couple of years and far beyond that.
Who in your mind will be the winners in the evergreen fund space, and what will it come down to? So what I mean by that question is it going to come down to brand, distribution, education? And I'm sure there's no one specific answer, and obviously performance has to be there. That's table stakes. But in your mind, what creates the winners in the evergreen space?
Well, being a vivid reader of your newsletter, we're trying to check off all the boxes. I mean, clearly, these products aren't bought, they're sold. And educate. I cannot emphasize enough on the importance of education. And not only education in terms of making sure people know what they're buying. No, you need to educate people on what is private credit. How does that fit in anyone's portfolio? Before you even talk about how does it fit in anyone's particular sort of asset allocation. So you really have to think educating advisors and making it easy for them to replicate that and tell their clients about it. So education is key. Distribution is key. You need, if you want to reach many advisors, this country has over 300,000 financial advisors. You need a lot of bodies to cover them. Not that you need to and want to cover all of them, but you can't do this with just a handful of people. You can start there, but over time, distribution is absolutely key. And the third thing is you can't just throw anything against the wall and hope that sticks. So you got to be very thoughtful, what I mentioned earlier, on how you think about product development. Just because you have a big brand doesn't necessarily tell you that you're going to be succeeding at something like this. So you got to be very thoughtful in terms of what's the investor interest and need? What solution can I create? How do I communicate the solution? How do I educate advisors? And in doing all that, building a brand, a trusted brand that people understand that what you're building is not only thoughtful, but reliable when it comes to the investment outcome that you are promising to deliver.
On that last point, how important do you think it was to be able to build this business within Nomura?
Very much so. I wish I could say that, doing this completely entrepreneurial, that would have been great. But the reality is, and this goes back to what we talked about earlier, the competitive dynamics have shifted so massively over the last couple of years. When I started this journey, I thought 100 billion of seed capital is great. And don't get me wrong, it is great. But if I were to do it again, I would probably target 200, 300, maybe $500 million. That's what you see more and more often these days. So you need ginormous amounts of capital, and partnering with clients is equally important. That being said, it's not sufficient to just secure the seed capital. You also need working capital. You need to hire talent. You can't do this with 5 people in the garage. So we have brought in the first 2 years, 25 individuals cutting across investment teams, distribution team, operations team, marketing, legal, compliance, the whole gamut. So you can't do this as a startup. Or at least I observed it to be incredibly hard. So I needed a partner that has a long-term view, that wants to invest in this business, that has a great brand. We're celebrating on December 25th this year, we're celebrating 100-year anniversary. And our founder back in the days was so forward-thinking that next year we have another 100-year anniversary, and that is being established in New York. And so that is something that was very important to me, to have a firm with a very long-term horizon, that at the same time, there is a brand that, I think if you ask people about Nomura, most people would say, yeah, I've heard the name. But what exactly it represents, where it's from, that's an opportunity for us to really upload this brand and tell a lot of people about who we are, what the firm is. And needless to say that when we were founded, we started in wealth management. So to this date, Nomura is one of the largest wealth management firms in Japan. We serve more than 5 million households in Japan. Of our 100% revenue, 30% is still with the local Japanese wealth management business. So we know our fair bit of client needs, how to serve households, how to think about holistic financial planning, the shift from brokerage to advisory. So we use that experience and embed that DNA into the fiduciary way of how we operate the asset management business here in the States.
I think that's such a fascinating point, because it feels like the Japanese wealth market is one that many of the largest alternative asset managers are paying a lot of attention to right now. A lot of firms have hired boots on the ground there to serve the Japanese wealth market with their US product set. You almost have the reverse where you have a very strong home brand in Japan and a large wealth management footprint in business. Now you're trying to build out the capabilities in the US to serve the US wealth channel. What do you think you can learn from what you've experienced in Japan as a business that you're applying to building the business to serve the wealth channel in the US?
Yeah, I think the Japanese culture is quite conservative, quite frankly. And so one of the major initiatives in the country is how do you actually bring down deposits and shift them into investment products? That's a big, big focus. And Nomura plays a very significant role in doing that by helping us as well as other asset managers coming into the Japanese market. So there's a certain openness, and that openness we actually translated into how we think about investing here in the States. So our open architecture oriented private credit strategy, for example, that we started, can actually is no different than bringing other managers to the Japanese market. It's that openness of and diversification of approach. And so we have that DNA, so to speak. And that is something we're trying to embed into how we deal with the business here in the United States. Now, obviously over time, and we are having these conversations already, Nomura has a global sort of network of access to clients, whether it's in EMEA, Asia, ex-Japan, and of course in Japan. So over time, I would certainly hope that we can tap into those clients and the distribution access that the firm has at the global level. But you got to start somewhere, and has served us pretty well to do that a little bit here, focus on the, especially for us currently on the RA client segment with sort of a diversified approach to private credit investing.
On that point, why focus on the RIA client segment as opposed to other parts of the wealth channel? I've talked about this. Wealth is not monolithic. There's different types of clients. They have different needs. They need to be sold differently. They can be educated differently. Why start with the RIA channel?
So first and foremost, we are an RA as well. Nomura Capital Management is a registered investment advisor. So we have a fiduciary compass. So do our clients. So I think first and foremost, there's an alignment of fiduciary thinking, mindset, and responsibilities. Number two, this is also in a channel where you have thousands of RAs that you could target. So with a finite amount of resources, the question is, who do you want to target? I think it would be tremendously harder to go to some of the larger wealth platforms from scratch. I think that is very hard to achieve. Over time, you certainly want to get there, but it's going to take some time and it's going to take a lot of resources. So we feel fiduciary mindset is fully aligned and is a fairly cost-effective way to cover a pretty large part of and growing part of the market.
What in your mind is the most challenging aspect of working with the RIA channel?
You know an RA, you know an RA. That's the key point. And you can meet an RA that has 10 billion and they only do passive indexing. Next day, you meet an RA that has 500 million and they only do GPLP drawdown funds. Like, it really depends on the RA. And so I find this a very fascinating space. The point is you have to go client by client, and it's not done with one meeting, quite frankly. So it's an area where the first one or two meetings was like, who is Nomura here? Then you talk about private markets, private credit, before you even touch upon a solution. So it's probably, you know, by meeting 5 or 6, when you really drill down into the actual solution that you offer. I find this fascinating because you get to know essentially all these RAs are entrepreneurs. I would consider myself an entrepreneur, even though I'm doing this inside a larger firm, but the mindset is still the same. And so it's almost like entrepreneur to entrepreneur. So I appreciate that they think, let me put it differently. Investment solutions and investing is one of many things they think about. but it's maybe they spend 10% of their time, maybe 20% of their time on this. They have to think about the technology stack, hiring people, who's the client base, how to attract more clients, compliance, legal, you name it. They have to think about a lot of things. And I find this fascinating. I was always fascinated by entrepreneurial people. My father was an entrepreneur himself. So that has always fascinated me. And if you then add the fiduciary alignment, to me, it's the most natural client segment to start with.
I know you have to avoid conflicts, but does it ever go both ways? So where my mind goes with that is these firms are businesses themselves. The founders are often, they're entrepreneurs building a wealth business. Sometimes they need to access capital too. If you look at the Cliffwater Fund as an example, a lot of their borrowers are actually in financial services, some of which are very large RAs. Do you think about that similarly as well, where sometimes these firms that you might work with as LPs in your fund, they could also be potential borrowers as well if they need access capital to grow?
Essentially, yes, absolutely. But I would more think about it as they are partners. I view them as partners, the clients and partners. How can we help them succeed? And whether that is in the short run, it's can we help them build better portfolios on behalf of their clients? And we think the answer is yes. And now over time, you would hope that to evolve. Maybe we have more investment solutions, all the way to can we help them in the broader sketch of things in terms of what Nomura has to offer, not only from within our own division, but across the board. We can help them learn from our experience on distributing to Japanese investors and their mindset and their buying behaviors. So there's a lot of things that over time, in the spirit of partnership, we feel we can evolve alongside our clients.
Well, you mentioned more broadly offering the Nomura platform to the wealth channel. On that point, you recently acquired another business in the space, Macquarie's business, that's going to be part of Nomura's business. How do you think about the strategic imperative there and what that does to be able to serve the wealth channel?
Yeah. Think about what we talked about earlier. You need a brand, you need lots of investment capabilities, you need lots of distribution capabilities. And you want to really build a business that allows you to create more solutions cutting across public and private over time. Doing this all from scratch, and I can tell you this from the last 3.5 years here at Nomura, is great. It's very rewarding, but it takes a lot of time. So what this transaction allows us to do to leapfrog time. So we get a lot of investment capabilities, a lot of distribution capabilities, a lot of operational capabilities, whether it's operations, IT, technology, data and analytics, compliance, legal, risk, you name it. And that is something that it would take decades to replicate that. So it will allow us to take our existing products and distribute it to a larger audience, to take other products and distribute it to our current audience, as well as to create product that cut across public and private, which, as we talked about earlier, is where we're headed towards anyway. So it really allows us to position ourselves for a lot more growth to come over time.
I think tying together a few of the things we've recently talked about, I want to ask you a question about the wealth space, because you said one thing which stood out, which is, one RA. But there's also a lot of market structure change and evolution that's happening in the wealth management space. How do you think the RIA space is changing? And how do you think about heading to where things are going when it comes to making sure you're serving the RIA community?
Yeah. I think it's fair to say that the RIA segment is changing quite dramatically. I'm not sure I get the data points exactly right, but I think directionally they're right. 10 years ago, there were 10 RAs with 10 billion of assets or more. I think now there's 280 RAs with 10 billion in AUM or more. It gives you an idea of how this space has evolved. Now, on the top end, you have some firms have hundreds of billions in assets and won't take too long until you get the first RA that has $1 trillion in assets under management. So at the end of the day, some of those firms are essentially look and feel like mini wirehouses. So I can see almost a bifurcation over time where you have some of those, a handful of those firms. And then maybe on the other end, you get some people being tired of that and becoming independent again. So almost like a cyclical journey by which you have more consolidation leading to a defragmentation over time. So that's going to be interesting to watch. For us, quite frankly, it doesn't matter. It just means we have different firms, different size of firms that we need to interact with. And the buying behaviors can be different. Even a large RA doesn't necessarily mean it's all top down. So some RAs I would classify as you have centralized manager due diligence and investment research. So you gotta like go through this to make it onto the platform. Fine. But then you still have to talk to the individual advisors once you are on the platform. That feels very much like a wirehouse to me. Other firms are much smaller and it's total centralized decision making. It's allocation across the whole variety of client segments in one go. But it really, like, again, to my point earlier, you can't just assume because an RA is larger than another that the whole buying behavior and the whole construct of how you go from making investment decisions to research recommendation to portfolio construction is the same. It's not.
Does that drive how you structure your team and create the right coverage model?
Over time, yes, for sure. Right now, we have a small team that is really doing a great job in treating every client the same way. Now, as we progress over time, there are certain firms that you can do more with and other firms that maybe aren't just ready yet for private markets. And so that definitely has an impact in where they spend their time. But over time, what I foresee happening is there's going to be two ways, one of which is you serve certain clients and that's all great, but they have their way of consuming your solutions. But then you have others who may be interested in a broader partnership. And that doesn't necessarily need to stop at the asset manager. That's where actually the beauty of a global firm that has tremendous capabilities, not only in wealth management in Japan, but also in corporate investment banking activities, other parts of the asset management business globally, can really help serve those clients and their evolving needs.
I think that's a really interesting point because that shows that there's a broader platform component to this. You can really sell the platform rather than just sell a specific product or solution.
You got to start somewhere. And to be fair, like we started with one solution. Essentially that it's a startup inside a larger firm. But as we progress over time, we've added a second solution already. And there's going to be a lot more to come going forward. But again, the idea is we're not in the business of creating as many products as we can. We're in the business of serving our clients and their evolving needs. And that will continuously require more investments on our end. So far, we've done this fairly organically, whether it's the public credit team that manages high yield bonds, all the way to what we're doing in private credit. But over time, I would expect us to do a lot more inorganic activities, the one we've already talked about, but certainly others especially in the private credit space.
This and a few other things you said earlier kind of get to something else I want to touch on because that stuck out to me of you have you wrote a 10-year business plan. This space is evolving so rapidly. You said it's still in the early innings, which I think it certainly seems like it is, but it's also moving very fast. Where do you see, when you wrote that 10-year business plan, where do you see private credit and alternative asset management being the end of those 10 years? We're now a few years in, so it's not quite 10 years away.
I think one key conclusion is, and again, it goes back to the point, I'm very glad I found Nomura as the right home for this, because directionally right, but wrong in two ways. One is everything is going to take longer, and everything, therefore, is going to cost more money. And so I'm glad to report that having the backing of 100-year-old institution is incredibly helpful in that regard. Now, you want to be ambitious. I think we were realistic yet ambitious. That being said, hiring people takes longer, especially in this environment. Dealing with the SEC takes longer. Maybe it gets better soon, but these things just take time, and there is a certain factor of unpredictability that you can't predict. And like a 10-year business plan, let's just say there's a lot of assumptions in a 10-year business plan. We're updating on our budget almost like on a monthly basis based on flows and all that good stuff. But the bottom line is you need to have a long-term horizon. That's kind of your North Star where you want to head towards. But as you progress towards that, you do realize that reality catches up with you in the sense of it takes longer, it's going to cost more money, but directionally we're on the right path. And I'm very happy about that.
What are you most worried about in private credit as an industry, particularly as more capital comes into the space, more investors come in?
I'm most worried about investors investing, not knowing what they're investing in. That to me is the key point, which goes back to education. Whether you talk about, we can talk a lot about semi-liquid structures. Sounds great, doesn't it? But the reality is you cannot sell this as a liquid instrument because it's not. So what we keep telling every prospect and client is you invest in these structures, think about them as pretty much illiquid. Because when you need liquidity, it won't be there. Highly unlikely that there will be liquidity when you need it the most. So you need to have it in a part of the portfolio that you would consider illiquid in nature. This goes back to, that's why I don't want Mrs. Smith to own, that has 100,000 to own, like, I don't know, 10, 20% in private markets, because that's not the right investment for Mrs. Smith. Whether she is 35 or 85, it's not the right investment. But someone who has 1 to 10 billion, that's a different story. And so to me, again, this goes back to making sure that advisors understand what the solution is, how it fits in anyone's portfolio, and that these type of structures should not be considered as liquid structures.
How do you think the evergreen space evolves in that context? And do people still continue to pick evergreen structures over closed-end vehicles?
I think time will tell, quite honestly. So there's a lot of buzz around evergreen structures, rightly so. There's a lot of academic work around what has the better premium. Is it an evergreen structure on a total fee-adjusted basis versus the drawdown funds, etc., because you avoid the J-curve and all that stuff. So there's a lot of good arguments for evergreen structures. Quite frankly, I think at the end of the day, it depends on who's the end client and what solution fits best in which type of structure. So the actual structure, as I said earlier, comes at the very end of the product development cycle. So do I believe, for example, the private credit strategy that we've developed where the whole idea is diversification? If your end client is the $1 to $10 million household, an evergreen structure probably is the right structure. That may not necessarily be the same for a $100 billion family office. So it really depends on who the end client is.
How do you think it's going to evolve when it comes to something else you mentioned earlier, which is thinking about the combination of products within private markets, private and public being combined? How do you think what you just said relates to that continuing trend and evolution?
Yeah, so I would add model portfolios in that as well. So the whole evolution of, if you go back 10 years, no one thought about model portfolios really. And today, that's how most ETFs and mutual funds get sold. And I think that trend is not going to stop. On top of that, I would add that adding public and private together in the broader portfolio construct, that is something that will continue to evolve. And it becomes a question of what am I trying to solve for if I have return or income, liquidity needs, and diversification. And so if you're thinking of solving for these parameters, the outcome may be different depending on who the end client is. So some end clients may say, I want to give up liquidity for higher income. Others may have a slightly different view. How you structure that and what the best vehicle is, time will tell, whether that's an interval fund, whether it's a tender offer fund, whether it's an ETF. Time will tell on that front.
What are you most excited about for the next phase of private markets, or maybe as we get into the middle innings of the game?
I am incredibly excited about the speed of transformation that this industry has demonstrated. And by speed, I mean, yes, there's a lot of consolidation happening, and it looks like this time for real. There has been a lot of growth, historically driven by markets, but also increasingly by flows. Think about the wealth channel, for example, but also insurance companies, sovereign wealth funds have poured a lot of capital into this space. But another area that has evolved quite a bit is partnerships, whether that is a public or traditional manager with an alternative manager, whether it's an RA with an alternative manager, whether it's insurance companies with a handful of asset managers or sovereign wealth funds and the likes. So that level of partnership is something that, quite frankly, I didn't expect, especially not in the speed by which this happened. And I think we are just at the beginning of that also.
Do you think that's going to continue, or do you think as firms get bigger, we'll start to see firms breaking away from each other because they're going to overlap in what they do and it might be too competitive?
That's an interesting one. I don't know. Sure, we'll see some pretty interesting breakups where lots of tears will be shed. But quite frankly, if you are capable through partnerships to access much broader set of clients, so the pie gets bigger and you just have a smaller share but of a much bigger pie, I don't see any reason why we won't see more partnerships and why it's fruitful for everybody, the partners as well as the ultimate end client.
Well, the other thing related to that too is perhaps the market is bigger than we thought. You mentioned earlier, and let's take private credit as one example. If people thought of it just as direct lending, that's a certain size market. But if you take what certain people think about how big private credit universe is to include ABF and real estate lending, all sorts of things that historically were part of what banks did or had on their balance sheet, much bigger market. Do you ascribe to that view that maybe as the market gets bigger, then there's plenty of room for a lot of different players to win?
Absolutely. But again, at the end of the day do you have a differentiated investment solution that fits a client need? That's where it all starts. So I would encourage everyone that thinks about this space, not just throw spaghetti at the wall, but really think hard about who's the end client? What am I trying to solve for? Do I have the expertise? And if I only have some of it, where can I get the rest? Can I partner? What network of originators, for example, do I need to build, or other partners? And that, to me, is that's actually, to me, that is fun to think about. That's where just because you have a certain size doesn't necessarily mean you're going to have guaranteed success. It requires continuous evolution. If you take tech companies, for example, yes, we have the Magnificent Seven and stuff like that, but like some firms that have been huge at some point in time have completely disappeared because they were not capable of continuously reinventing themselves. So to me, if I apply that analogy on the asset management industry, you have to actually think differently. Like, how do you protect your existing business, but how do you evolve from that? Now, you're not going to see assets shed overnight, but you certainly have to continuously innovate and evolve to stay ahead of the game.
I think what that really gets to is what you talked about throughout the conversation today was just first, you have to really know yourself and know who you are as a firm, and you've done that. So, Robert, thanks so much for coming on the show. This is a fantastic conversation.
Thank you for having me, Michael. Appreciate it.
Pleasure.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going